Well, good afternoon, everyone. Here from Kansas State University. My name is Brian Briggeman. I'm a professor here in the Department of Agricultural Economics at Kansas State University, and also the director of the Arthur Capper Cooperative Center. And here I'm going to share some perspectives of what this Ukrainian-Russian conflict might mean towards the United States in particular, and just trying to think a little bit, a little more focus here, but definitely there are some global ramifications as well. So I'm going to go through these sets of slides and definitely hopefully have some time for questions. But as we're going through, if you have questions, feel free to put them in the chat. So when we think about, well, war and in a macro context, the first thing that always comes to my mind is that war tends to spark inflation. Here I look back over in the case of the United States when the U.S. was in a war conflict here, just looking from War of 1812, Civil War, World War I, II, Korean War, and Vietnam. You can see those annualized consumer price index or inflation rates tend to be quite a bit elevated above where, at least today, the Fed would look at more of a 2% measure. So we look here, World War I being the highest of about an annualized rate of 22% roughly, and World War II and Civil War being there. So can be quite a bit higher in terms of those inflationary pressures. But why, at least here looking at the US, and I would even think globally, a lot of these reasons would apply. Why would we see that sparking inflation? Why would war spark inflation? Well, one of the, and it could be a combination of any of these reasons or just maybe a few of them. But typically we would see federal deficit spending will increase, right, to fund the wartime effort. And we know with those federal debt rising, that tends to be inflationary. Certainly supply shortages have occurred in the past. So looking at when we have that shortage of supply, that providing some upward pressure on inflation. Also, too, looking at monetary policy being eased, so lowering interest rates, or as we have come to know today, quantitative easing are other ways that we could see inflation being stoked and being sparked during times of war. At least here within the US, and you could look at other currencies as well. Here in the US, looking at those times, we tend to see the US dollar would depreciate in value. And that too can have those inflationary pressures up. And then of course, where we would ultimately see it related to those supply shortages, but energy and food prices have increased in the past. And we see that driving up that inflation. So when we look back over time of seeing what that, those annualized rates for various wars here within the US, we can see that inflation pressure coming up for some of these reasons that are listed here. And then when we look at the current situation here within the United States, since 2020, coming off of the pandemic, we have seen inflation has been rising. And now the question is it transitory? Many within 2021, including myself, would look at it being transitory for disruptions to the supply chain, supply shortages. Once we get through the pandemic, these things will work themselves out and we'll begin to have supply come back into the market and we'll see these prices come back. But where we're at currently today, the argument on the transitory is weakened. Without question is. Are there still supply shortages? Are there still supply disruptions? Absolutely. But it would appear that this tail is much longer, that these situations that are going on with these supply shortages, the supply chain disruptions, and now you add in the Ukraine and Russia conflict that Alan just went through, thinking about commodities potentially being disrupted, we have further supply shortages. So when we look at the inflation measures, whether you're looking at the headline measure that would include more volatile prices such as energy and food, or now even the core measure where you pull out the food and energy prices, the core measure, the red line you see here is what the Federal Reserve here in the US will focus more on. We definitely are seeing those go up and quite a bit, and going up in lockstep with each other. So certainly inflation has come to the forefront. We see it on popular press, in the media, social media. It is definitely something being talked a lot about. But as we look at the inflation picture here within the United States, it's important to kind of peel it back a little bit and see, well, what is driving a lot of these inflation numbers? Well, in the headline number, the very top graph really kind of shows that one of the biggest drivers for it. When we look in at the components of inflation, at least for the headline number, energy is one of the biggest drivers. So here you can see the CPI index for energy on a year-over-year basis. You know, we look kind of similar to how it was back in the 70s in terms of that year-over-year increase. And as we look for maybe potential disruptions coming from energy production within Russia, that could provide some continued upward movement pressure on those prices, something that we will need to monitor going forward. If we look more at the core measure of inflation, one of the biggest drivers for it is on durable goods. That's the bottom graph there. When we look at those durable goods and looking at those year-over-year changes, you know, like the last real significant inflationary period in the United States, it's very much like how it was in the 1970s of looking at those durable goods being pushed up. And a lot of the drivers for that are new and used car prices. Getting new cars coming in. You hear many stories about dealerships saying, this is the inventory that we have available. You can choose. There's no selection or customizing. This is what it is. And the one other thing too, as we think about in Russia, palladium, which is an element used in creating catalytic converters. If that is disrupted, the supply of that could have further ramifications for producing cars, and that might continue to push upward pressure on new car production. And then when we looked at used cars, those prices are still elevated as well. And a lot of that is driven by coming off of the pandemic in 2020, where many rental car dealers got rid of their fleets, really reduced their fleets down, and now they're trying to build back up those fleets. And the reason that's important is a lot of the rental car market here with the US, they provide a lot of used car sales out there. So now that they're competing with US consumers who, by the way, have additional amounts of money in their checking accounts, from what happened in 2021, various government programs, most notably a $1,400 stimulus check that came to US consumers at that time. All of these things just point towards upward pressure on these prices. And maybe it's not necessary, you couple that in with supply chain disruptions, the inflation picture looks to be concerning going forward. It's something definitely I know folks within the Federal Reserve, at least what we read in reports, are aware of and are discussing. But when we look at, food and beverages, you see a more subdued inflation story, at least currently, coming through. I think when we consider the Ukraine and Russia conflict, focusing in on the United States, a developed country, isn't the real picture, doesn't show it all. Many developing countries where much more of their incomes, household incomes, are spent on food, and where we can see those prices rise quite rapidly. That's where a lot, from the global perspective, much of my concern is at right now, is looking to see how sharply are those food prices rising in developing countries. And I would imagine it's going to be pretty staggering going forward, especially when you look at the price of commodities. Where we pull out food and energy, the bottom graph here. How is the Ukraine and Russia conflict, this items that Alan talked about, uncertainties within production and getting a new crop planted and getting the old crop out into the marketplace, really points to these commodity prices will have to come up because of the supply, and have to look for other markets in which to draw and meet that demand to see those prices be elevated. And clearly in that graph there at the bottom, you can see, at least on a year over year basis, those commodities, when we strip out food and energy, are quite elevated. And we see that within futures markets, where we see price of wheat, I believe, is at $12 a bushel right now. So we see those markets really being influenced and are going up. And a lot of it, ties right back to the Ukraine and Russia conflict. But the other side, too, as we think about this is, thinking about demand for US dollars and what about US exchange rates. Clearly, we look within Russia and what's going on with the ruble, the collapse in it and the value of it, where we saw the Russian central bank increase the main rate from 9.5% to 20% to try to provide some support. Even going as far with the Russian state saying Russian businesses are ordered to sell 80% of their US dollar assets held abroad. Again, trying to push in that influence of holding and provide support to ruble. But at least for right now, when we look at the demand for US dollars, it's quite strong. I pulled down just looking at the exchange for US dollars, $1 US to rubles. And when I pulled this down over the weekend, we were looking at it at about $100 to 110 rubles. I believe this morning, last I looked at it, was already at 137. So we're continuing, at least within Russia, that continued decline. The US dollar is still remaining strong. And if we look at it in a US dollar index held to a broad basket, you can see on this where going into the 2008 financial crisis, certainly it went down, but then it spiked back up. We built the strength of the US dollar up and even held through the pandemic, actually got quite strong as US dollars were viewed as safety and stability in the marketplace. And now we've returned to really where we're at today, about at those pre-pandemic levels. But there's a lot of questions and a lot of discussions of, as this Ukraine-Russian conflict continues and as we have repercussions from, say, the United States and other developed countries on Russia, how is that going to affect demand for US dollars? This is a big point of debate, and a lot of it, a lot of questions are being raised about how will that dollar hold up. One that is currently being discussed right now has to do with SWIFT. And so, what is SWIFT and why does excluding Russia from SWIFT matter? So first of all, SWIFT is the Society for Worldwide Interbank Financial Telecommunication. So SWIFT is a cooperative that provides safe and secure financial transactions for its member financial institutions. So really all SWIFT is a messaging network to transfer information, to transfer fund information, not to actually make any of those, where you have a lot of the trade that goes on, but it's more that messaging network that exists where these banks are part of this co-op. And here we've heard come out the US, the European Union, the United Kingdom, Canada, and now Japan are going to remove 7 Russian banks from SWIFT. And they're doing it more in a targeted way to identify those banks that are tied more closely to the Russian state. In effect, trying to affect their ability to fund this war effort. But there was a lot of discussion, especially pushback from European Union countries such as Germany, about not removing Russian banks tied to energy, because a lot of the energy that they purchase over there comes from Russia. Now, how this ties into the US dollar and demand for it, many of the oil and other commodities that are purchased with US dollars. So these countries such as Germany have very large reserves of US dollars so that they can go out and purchase the energy, for example, that they need. So for at least for them right now, it would make sense to keep those Russian energy banks within SWIFT, so those transactions and the messaging that goes back and forth between those banks can occur. But if we were to strip those out and to see those, say Russia, would decide to go to other systems, because there are other systems out there. There are cryptocurrencies. China is starting to build up their own messaging network. If Russia were to pull out and say, no, this is where if you want to purchase energy, we're no longer tying it to US dollars, it's going to be tied somewhere else, at least the energy that we're producing. Now you begin to have that concern for, will that actually reduce the demand for US dollars and could create that price depreciation in the US dollar, which for us in agriculture can be good because we're more competitive on the marketplace. But the US is the nation of consumers. And if we are not able to bring in our imports with a stronger dollar, that can lead to inflationary pressures. So this is definitely kind of as I view it, it's more of that first shot. We saw this with Iran back in, I believe it was 2012, when Iran was removed from the SWIFT system, but it wasn't really until the banks were targeted themselves, where assets were frozen and fines were levied. That's when that really hurt the financial system. So right now, this almost seems like a first step in terms of removing them from SWIFT, but definitely something we're going to have to monitor as it progresses through, and how will Russia react, and will there be additional sanctions going forward, because it does have implications for demand for the US dollar and US exchange rates. The other thing, I mean, ultimately here within the US is, how is the Fed going to respond? We're still building in a lot of that information, trying to understand what's going on. We know that Chairman Powell has come out and said there will be 2 rate increases in 2022. The market, everyone pretty much has factored in their March meeting later this month. They will make a rate increase announcement. But the market is even beginning to factor more and more of those changes in, and continued rate increases even for 2023, for many of the reasons I talked about before, with the questions of how transitory is this inflation. The other thing I like to bring up with quantitative easing, yes, interest rates is one way, the primary way the Fed can help control inflation, but also quantitative easing has played a significant role as well. Here I show a graph of the Fed's balance sheets. And if you all have heard my presentations before, I like to show this because it just really illustrates how large these asset purchases have been and how much quantitative easing has occurred here within the US and the Fed. So before the financial crisis, the Fed would operate with about $850 billion in assets, primarily help to fund their own operations. Today, we're over that 9 trillion mark, as you can see how it has just steadily increased. And I like to show the shaded regions, because there are 2 regions in particular I want to draw your attention to. The first is the red. Thinking about mortgage-backed securities, today, the Fed, so purchasing mortgage-backed securities, represents about 25% or so of that entire mortgage-backed market, about 25%. And the questions is, why is this continuing to still happen? Because the reason that it was put in place back in 2008 was Chairman Bernanke at the time said the missing piston within the US economic engine was our real estate market, and that needed to have support. And in fact, there for a period of time, the only mortgage-backed securities that were being purchased primarily through the Fed. But today it represents still about 25% of that market, continuing to provide that support to mortgages. So when we think about that, is that an area that the Fed could begin to ratchet down, hopefully here fairly soon? There are discussions at least of adjusting quantitative easing, at a minimum, not using the proceeds from those securities that are being sold and reinvested back into similar securities. Hopefully that will stop, in my opinion, and we can begin to see that starting to flat like it did, or starting to fall like it did in 17 and 18. The other piece to look at is that orange part as well. And the orange represents purchases of U.S. treasuries or longer term U.S. treasuries. It's not, there's no other way to say it, but this is definitely trying to create inflation. I mean, without question, the Fed, when any country's central bank buys its own government's debt, that is monetizing the debt, that is trying to create inflation. So with the continuing of purchasing that, at what point, does that, lead to too much inflation? Are we starting to see that now? Will the Fed begin to taper off of these buying of these securities? Those are the two areas that really kind of shape up, a Fed's response to quantitative easing, and something to monitor going forward about what they decide to do. If we look at, inflation and where the market is expecting that inflation to go, whether it's a shorter term, a 5-year inflation break-even rate, or looking at a 5-year inflation rate or 10-year inflation rate, both have recently shot up. So we've seen that big increase. I think some of it is coming through, obviously, off of the pandemic, but the continued supply shortages, supply chain disruptions, and now you add in Ukraine and Russia conflict, that is continue to put that upward pressure on it. And it would, at least with the blue line, the 5-year break-even rate being above the 10-year rate, would suggest the market is expecting higher inflation here in the near term, and maybe beginning to abate a little bit in the longer term, at least out over 10 years. And just as a point of reference, typically the Fed wants to target this like around 2% if they can. So definitely the market is expecting that higher inflation. But the case for beginning to go and fight inflation is, the economy itself here in the United States, coming off of the pandemic. We are on much firmer footing, and in particular, looking at the labor market and looking at labor in general within the U.S. Coming off of the pandemic, and during the pandemic, we saw that unemployment rate, as you can see in the top graph, shot up. We had initial jobless claims that were on record amounts. When we shut down the economy, it really was a huge disruption, not to the labor market, which ultimately affect the amount of consumption we could have. Because if we think about gross domestic product, or GDP here in the US, about 70% of it comes from consumption. And where we get the consumption from is from a strong labor market. And so we had that huge unemployment rate, but now we've worked down to very low levels. I believe the last unemployment rate was at 3.8, 3.9%. So looking at even before the pandemic, job growth has gone up. So we've seen that improve. The other side is we have seen wages and salaries shoot up as well. Certainly many of us here in the United States have seen the signs, enticing people with bonuses to come and start work, or higher hourly rates. And when we look at the data for private industry workers, you can see that those wages and salaries are quite high. And to me, whenever I have looked at the inflation outlook and where it is going, one of the missing pieces for real large increases in inflation was we haven't had a lot of increases in wages and salaries. Typically when that happens, so have to pay our workers more, and then that gets passed through to consumers vis-a-vis higher prices. Now we're starting to see those wages and salaries are beginning to pick up. If that trend continues, you could expect, employers or businesses passing through those added costs through higher prices. So when we look at, the case for higher interest rates to begin to curb inflation and dial back quantitative easing, the U.S. economy is really, on much firmer footing, especially when we look at the labor market. So with the Fed is being expected to have 2 additional interest rate hikes. It's good to look at what the market is saying in terms of like where might those rates go? How high could they be? The graph on the left looks at basically an implied 1 year out interest rate. So looking at where that 1 year out implied interest rate will be. It's done by calculating the 1 year forward and 2 year swap, using the 2 year swap as your longer term. And that's the blue line that you see on the graph on the left. Today, it looks like it dipped, but it dipped for just 1 day, but it's actually up and sets at about 2.06%. Today is where it's at, 2.16%. So that's looking in March 2023, where these 1 year rates could be at. At least that's what the market is building in. The reason I bring up that 2.06, 2.16% is if we look back over here over time, this implied rate coming off of the pandemic began to increase as the market, what that tells us, the market is expecting the Fed to begin to raise interest rates. And if we look back about October, November of 2021, we set at about, just under, 1.5%, where today, we're up over 2%. And one of the big things that have changed over that amount of time is the Ukraine-Russia conflict. And how will this continue to affect? Will we expect additional amount of rate increases going forward? This will be something that will need to be monitored as we begin to get more information. You already hear many folks saying the market is ready for not just 2 increases in 2022, but continued increases through 2023. But what's the risk appetite right now? How's the market? Yes, maybe they're factoring in higher interest rates, and that's the expectation. But what about the risk aversion? What's their appetite? Where are they at here? One way to look at that is the US 2 year swap spread. And the easiest way to think about this is there's more demand for these swaps and these spreads, as there's more demand for it, they're going to build that up. And the reason that you would have demand, you build up the price for that is because of higher levels of risk aversion. The best way to show that was when we were going through the financial crisis of 2008, there was a lot of risk aversion within the marketplace because of so much uncertainty, to the point it almost bid it up to $160. Today, if you look at where we're at right now, it's down there about where we have been following the financial crisis. And even during, the pandemic, we didn't see that rise a great deal. So the risk aversion really remains low, especially as we look back to that financial crisis and where we were at there. So just kind of an idea, this gives you a little bit of an idea of where the market is at. So to just kind of wrap up, because I wanted to leave time if there are questions, just kind of some bullets to be thinking about in summary, and then ultimately kind of at least a takeaway for those of you on the call, and we'll get into those of how should we approach this. Well, inflation's rising. We especially see it in energy and durable goods. There are definitely supply chain issues and probably only worsening with this conflict. The question, how long is this going to last? With the conflict, with these continued supply disruptions, has definitely caused a lot of this inflation beginning to raise and go up. Definitely the market and the Fed, they're ready to raise rates, but will it be enough to curb higher inflation? One way that interest rates and how to fight inflation was always described to me is that it's like steering a ship in harbor, right? You have to start turning the ship well before you have to go dock. Interest rates to curb inflation are the same way. We need to begin to raise those rates before, so it can work itself through the system. But it's always a balance, because as we raise those rates, we threaten hurting the overall economy. So we'll need to, be monitoring this and looking at it. Are we raising rates too late and inflation is getting away? Or is it the right time to where we begin to let it rise, not hurt the economy, and inflation can become under control? So the U.S. economy, labor, wages, and strength of the dollar are on good footing. But coming off the pandemic, we're at record borrowing levels here within the U.S. government. Our debt to GDP ratio is above where we were feeding the wartime effort of World War II. Can that good footing hold with rising interest rates? At what point might this become a real challenge? So we need to be monitoring that, because it's a unique situation we're in, coming off of shutting down the economy. And now we're looking at inflation. We have all this debt that's out there. And now we have this conflict. So for you all, whether you're here in the U.S., I put U.S. agricultural producers, but to be perfectly honest, you could probably put in any country there. Focus on what you can control. I do a lot of work with cooperatives and other businesses, and a lot of people talk about it in blocking and tackling, right? Doing the fundamentals well. What can control? For producers right now, there's going to probably be some real opportunities, maybe coming off of this last year where profits were quite sizable, maybe going forward, depending where you're at and planting and decisions to be making. Maybe again, 2022 could be a very profitable year. And whenever I see that, from my advice to farmers is focus on that balance sheet. Get your balance sheet as strong as you possibly can. Build liquidity, working capital. Find ways to build that up so that you can weather downside, but maybe even our downside risks. So if something happens, you have liquidity to fall back on or cash, but maybe to seize opportunities in the future. And then to think about solvency. How much debt do we have within our business versus equity? How solvent can we pay down some of that debt to have that under control? So building your balance sheet, very important. Being highly efficient, managing your costs, your operations, being as efficient as you possibly can, because many of these other things that are going on, looking at fertilizer prices and where that's all at, other prices going on, it's outside of your control. So how can I be as efficient as I possibly can, controlling my costs, and then looking at operational efficiency? And then also, with rising interest rates, fixed rate financing might make sense, to where it would be, where in applicable situations, because there still are opportunities to lock in and to look at those lower fixed rate financing. So with that, I will stop here and then go over here to look at some of the questions, if we got a few. So.
They start with Lucas.
Yep.
How many of these wartime periods? Okay.
So Lucas asks, in how many of these wartime periods was inflation already running hot prior to the war? In a lot of those situations, Lucas, it was actually fairly flat, progressing along like you might expect, like that 2 to 3%. But when those, at least in those times, a wartime effort hit, it really shot up. So tend to be not as hot. And I think that's a good point, because I made it specific on that slide. That was when the U.S. was engaged. Currently, we are not engaged in this war, at least formally, like entering the war or conflict. So if that were to happen, yeah, it could run up even higher possibly. But again, that's all to be seen. Next, what kind of demand destruction occurred? Okay, so great question from Jeremiah, looking at demand destruction occurred during elevated inflation periods. It certainly happens, right? When we have that very high inflationary period. I mean, for here in the United States, within the 70s, definitely we saw a lot of demand destruction, from those very high prices. And I think that leads into the deflationary periods. Nations never as levered as we are today. In the 70s, definitely not nearly as levered. And the Fed showed us how you fight inflation. You target the money supply, you let interest rates rise until you get it under control. And what the Fed did during that time, they caused a double dip recession in the 80s. It was very painful for a lot of folks. Today, we've never seen this amount of debt that we have, where we, if interest rates were to go up, those would create sizable interest payments. So there's going to be a lot of pressure. Yes, the Fed, they are apolitical, right? Yes, Chairman Powell is appointed by the president and reports to, makes reports to the Senate, but they make decisions independent, right? They do focus on strong labor market and prices, controlled and under control for rising. So for a while, they've been telling the U.S. government to get your house in order, because if interest rates have to go up, they have to go up to maintain our dual mandate. That will be interesting to see how that plays out, because if we do have those interest rates go up and it causes all other problems, how will the Fed respond? Will they, at least from what they've done in the past, how will that proceed? It's a great question. And I don't know exactly what will happen, because we really haven't seen anything like that in the past. There was a private one to me, basically, so what it is saying is, like, with all the quantitative easing we've had, the low interest rates, the amount of government stimulus that has gone in, I would even add on to it the 2017 Tax Cuts and Jobs Act. When you lower revenue coming into the government, but you do nothing on the spending side, that's going to be a challenge too. And the question is, will it take a really tough recession in order to get inflation under control? My hope is no, but I don't know, if I'm going to be perfectly honest. If history is our guide, what we saw in the 70s, that runaway inflation, it took a double dip recession and a lot of turbulence in order to get through that period of time. I hope that doesn't have to happen again. Hopefully we can get it under control, get supply chains running again, but there's a lot of signals out there that might not happen anytime soon. So if that's the case, then when I would do these inflation talks and talk about inflation, even but this time last year, wasn't as concerned about it, think we could do, but I always left it off saying there's always a black swan. There's always something that I'm not sure about. No one can perfectly predict the future because things can pop up. Well, the Ukraine and Russia conflict, there you go. There's something that could have lasting ramifications and could have something that could be pretty detrimental and could really hurt. Could it be that black swan type of event? Right now, got to monitor going forward, but it's an excellent question to be thinking about. So the question on another question from Jeremiah, does interest rates, right? If the Fed decides to go away from increasing interest rates, just to say, hey, look, the market conditions state that we really need to keep them low, be in a very accommodative stance, how can they continue to fight the economy going into stagflation or going into a period? Well, if we did enter into a period like what we had in the 70s, which was stagflation, is you have inflation, rising prices of goods and services, but also the economy is struggling as well, where you're even in a recession. Again, the lessons of the past would say, let interest rates rise and go through a painful period of time. So that's at least what it would be for history going forward. That doesn't necessarily mean what it has to be. It's something, that we'll have to continue to monitor, but Jeremiah, that's an excellent question and something to be thinking about. So the question from Jeff on employment participation rates, how are we relative to historical numbers? Because, unemployment is very low, but, businesses are still looking for workers. A lot of those workers, you're beginning to see that market heal. The latest jobs report, I believe, almost had, I think it was over 650,000 new employees. So that job growth is beginning to occur. I don't recall the exact participation rate, but today, but where it was set, the market was really set to where the labor market was set to where it could close that gap pretty quickly and get us back to those historical numbers. So yes, you are correct, Jeff, that we were below on participation, but we're beginning to close that gap fairly rapidly. And one of the ways is because of that, is because the wages and salaries are beginning to go up. The other piece of it too, at least for the broader economy, a lot of the jobs that were worked by service employee in the service sector were like my son, right, who's a teenager, go work at McDonald's or wherever else in the service sector. There for a long period of time, that wasn't happening for whatever reason, whether it's COVID related or just not working. But we'll start to see that come back, that part of labor force. The other piece with the unemployment insurance, the extra stimulus there going away, beginning to see that stimulus work out. I do feel that we will see, and with higher wages, see that begin to close. So yes, but we were below before, but I think we'll start to see that gap begin to close. So a question about, with looking at the prices of farmland and where that's going, is it just a flight to safety? Are there fundamental reasons, with farmland? Well, part of it, yes, there is a flight to safety and, on that, but also I haven't looked at the recent numbers, but I believe, farmers, agricultural producers here in the United States are still the primary buyer of farmland. And when there's extra cash. And like I said before, building your balance sheet, if you have the ability to buy farmland, then, at least history has said that farmers will go out and do that. And of course, with the lower interest rates, that pushes down cap rates and puts upward pressure on land values. And certainly some of the, supply and demand, obviously it's a limited amount of supply and it's a very thin market where you don't see a lot of farmland go up for sale, but there is certainly some of that, flight to safety that's occurring as well. But there are a lot of those kind of the reasons that we would see that remain elevated, and farmland values have remained elevated for quite some time. Question from Guy on how transitory do you think inflation is today? I think what we need to do is rethink our definition of transitory. In the past, a lot of these supply chain issues would work themselves out. We would get supply back to the market and bring prices under control. But we've never shut down our economy this way. And not just the US economy, but the global economy, where trade routes were disrupted for shipping and ports. How transitory is it? I think there are a lot of signals out there that this isn't a month thing, that we might be looking at a year, out to where we can finally get this, the supply issue. So when I, say transitory, it's not as we would think about it in the past. We need to adjust those expectations because this could have a really long tail and maybe even longer than what we're thinking. Especially now that we add this Ukraine-Russian conflict, because it's not just, agriculture like we're talking today, it's catalytic converters that I talked about before. Thinking about, lack of competition, inflation example with only 4 major meat packers. Like Alan, I'm going to punt that one to our resident expert in livestock economics, who is going to be talking in this session on livestock. So you can tune in to Glenn Tonzer's speech and discussion on Friday. I have no doubt he'll talk all about major meat export stuff.
Brian, I was able to look up some Kazakhstan numbers.
Sure.
And so I'll answer Thad's question. Kazakhstan produces about 1.9% of the world wheat production as of 2020. They make up 2.6% of world exports. In terms of, they export 36% of their wheat. Their major trading partners are Uzbekistan, where they, in 2020, 57% of their wheat went there. Tajikistan, 20%, Afghanistan, 10%, China mainland, 4.7%, and Russia, 3%. And so that made up 95% of the wheat. The big thing with Kazakhstan is they're landlocked and all their exports are going around to neighboring countries in terms of if you look geographically. And so I think in some respects, it's going to be difficult for Kazakhstan to go in and take up a lot of that wheat export market simply because of the landlocked nature, and all their neighbors are essentially taking the exports that they have. So hopefully that helps, Thad.
There was one final question of the conflict and a lot of rhetoric about moving to self-sufficiency in energy. I know they're releasing additional amount of supplies in the marketplace. Certainly, when we see the gas prices get as high as they are, where oil is now 130 a barrel, there's going to be a lot of discussions on supply being opened up, right? And trying to get that into the marketplace. I'd even go a step further. One of the things I saw on Twitter the other day, Scott Irwin is an ag economist out of the University of Illinois. Got to give him credit for this. And maybe this is something for Dan to be thinking about in his comments. But one of the things that he was building an argument for is calling emergency powers for Biden, saying, let's put CRP acres into production. If there really is going to be this global supply issue, should we in the U.S. consider taking emergency steps and allowing farmers to make the choice, still receive, I believe what he said in his argument was allow CRP payments to be paid, but allow farmers the choice to plant those acres because of the potential, supply issues. I haven't had a whole lot of time because I've been thinking about this macro talk, but that was something that I saw that I found really interesting and something to kind of to think about. And it definitely relates back to, like Philip, what you brought up of, self-sufficiency in energy, supplies on the oil side, but should we be thinking about crop supplies as well? The question John brought up to me, 70s saw a run up in land, and then the 80s we saw a collapse in land values. Are we in the same position? I would contend that we're probably maybe in a little bit better position. We look at balance sheets by and large for most farmers are a bit stronger than they were in the 70s. We haven't seen near the debt usage. And I know there's a lot of discussions about, especially on non-real estate, but there's been a lot of 0% financing on equipment and stuff. One of the things that pushed farmers over the edge was, with the shutting down of export markets, interest rates going up, and we had a lot of variable rate financing on our balance sheets. And when those rates went up, we couldn't afford our interest expense payments. And that's what ultimately led the bank to foreclosing on those land loans. And that sent land values really shooting down. This time is different, but there are a lot of similarities. And I think that just goes back to my comment for ag producers out there is get your balance sheet under control. Really strengthen it the best that you can, take these profits, build liquidity, manage the debt that you can, because those are things, cost efficiency, operational efficiency, stuff that's outside of your control, let it be that, but what can you get in and do? What can you control? All right. I think I made it through my questions here.
I don't see any more unless somebody wants to pop one in quick. We're about done for today. And we thank you all for being on. We'll be back here at the same time on Wednesday, and we'll have some stuff on fertilizer and the energy markets with Greg Eibendahl. So with that, and the link will be the same. So the one you got on with today will be the same as what you use on Wednesday and on Friday for the grain and livestock markets. Thanks, folks. Thanks, Brian. Alan, thank you.